Welcome back to the channel, everyone, and thank you for joining me today for what I believe is one of the most critical and timely discussions we have had in a while. Because if you have been watching the currency markets closely, especially if you have an eye on emerging economies, you know that something significant is happening with the Vietnamese Dong, or VND. The movements we are seeing right now are not just normal market fluctuations, they're signaling deeper shifts that have massive implications for international investors, for businesses operating in Southeast Asia, and directly for the Vietnamese economy itself. So over the next few minutes, we are going to dissect exactly what is happening with the VND, why it is happening now, and most importantly, what it means for you if you are holding or considering holding this currency. So let's start with the immediate context. What we are observing is a notable fluctuation in the VND, and this is not happening in a vacuum. It is directly tied to a broader re-evaluation of risk across global markets. You see, for a long time, Vietnam has been the darling of frontier market investors. It has been seen as a stable, high-growth story, a prime beneficiary of supply chain diversification away from China and a rising manufacturing powerhouse, and all of that is still true. But what has changed is the global economic environment. Interest rates in major economies like the US have remained higher for longer than many anticipated, which has put immense pressure on emerging market currencies across the board when you can get a risk-free return of over 5 PE. Absent holding US dollars, the incentive to hold riskier assets like the Dong diminishes, and we're seeing that dynamic play out in real time. Capital flows are shifting, investors are becoming more cautious, and this is testing the resilience of the VND in ways we haven't seen for some time. But it is not just about external pressures. We also need to look at what is happening inside Vietnam. The Vietnamese Central Bank, the State Bank of Vietnam, is navigating an incredibly complex situation. On one hand, they need to support economic growth, which has faced headwinds from slowing global demand for exports and challenges in the real estate sector. On the other hand, they must maintain currency stability to prevent imported inflation and keep foreign investors confident. This balancing act is becoming increasingly difficult when the central bank lowers interest rates to stimulate the domestic economy. It can inadvertently put downward pressure on the currency, making it less attractive to hold relative to the dollar or euro. This pushes the VND down, and this is exactly the dilemma we are seeing right now. The State Bank of Vietnam is having to make very tough choices, and the market is watching every single move they make very closely. Now let's talk about the implications for the Vietnamese economy itself. A weaker dong cuts both ways for export-oriented businesses, which are the backbone of Vietnam's growth model. A weaker currency can actually be a short-term benefit. It makes their goods cheaper and more competitive on the global market, which can boost export volumes. However, Vietnam is also here heavily reliant on imported raw materials, machinery, and energy for its manufacturing sector. A weaker dong makes these imports more expensive. It squeezes profit margins for producers and can lead to higher prices for consumers domestically. This leads us to the very real concern of inflation. Vietnam has done a commendable job of managing inflation in recent years, but a sustained weakening of the dong could undo some of that progress. Imported inflation is a serious threat. It is one that policymakers are acutely aware of. If inflation starts to creep up, it could force the central bank to reverse course and raise interest rates, which would then dampen economic growth. It is a vicious cycle that they are desperately trying to avoid. Now let's shift gears and talk about what this means for international investors and market perception. For years, the narrative around Vietnam has been overwhelmingly positive. It has been the go-to story for growth and stability in Southeast Asia, but recent events, including banking sector challenges and anti-corruption campaigns, have introduced a new element of uncertainty. Investors are now taking a much harder look at the underlying fundamentals of the Vietnamese market. They are asking tougher questions about regulatory transparency, banking sector health, and the long-term sustainability of the growth model. This doesn't mean the Vietnam story is over. Far from it. But it does mean that the era of easy money and unquestioned optimism might be coming to an end. Investors are becoming more discerning. They're demanding a higher risk premium for holding Vietnamese assets. And this is contributing to the volatility we are seeing in the currency market. International investors are recalibrating their expectations. They are weighing the undoubted long-term potential of Vietnam's demographics and its strategic location against near-term risks and policy uncertainties. And this recalibration is causing the fluctuations in the VND that we are seeing today. Now let's look at the regional context. Vietnam doesn't exist in isolation. It is a key player in Southeast Asia, and its economic performance has ripple effects throughout the region. The challenges facing the VND are part of a broader narrative of emerging market currencies under pressure, but Vietnam's specific role as a manufacturing hub gives its currency movements added significance. If the dong weakens significantly against regional peers, it could alter trade dynamics within ASEAN. It could impact supply chain decisions, as multinational corporations evaluate the relative costs of production across different countries. So regional investors are watching the VND not just as an isolated currency, but as a bellwether for broader economic trends in Southeast Asia. Now, I want to touch on a crucial aspect that often gets overlooked: the psychological impact of currency fluctuations on ordinary Vietnamese citizens and domestic businesses. For the average person, a weakening currency means their money buys less imported goods, become more expensive, travel becomes costlier, and there is a general sense of economic unease for domestic businesses, especially smaller ones that rely on imported inputs planning. NG becomes incredibly difficult. Currency volatility introduces a level of unpredictability that makes investment decisions risky. This can lead to a slowdown in domestic investment as businesses adopt a wait-and-see approach, which can further dampen economic growth. So the movements in the VND have real-world consequences that go far beyond financial charts and market trading screens. Now let's look ahead. What should we be watching for in the coming weeks and months? First and foremost, the policy response from the State Bank of Vietnam will be critical. How they manage interest rates, liquidity, and foreign exchange reserves will determine the near-term trajectory of the dong. The market will be scrutinizing every statement, every policy move for clues about their priorities. Second, we need to watch global economic trends, especially US Federal Reserve policy. If the Fed signals a pivot towards lower interest rates, that could provide significant relief for the VND and other emerging market currencies. Conversely, if rates remain higher for longer, the pressure will likely intensify. Third, the performance of Vietnam's export sector will be key. If global demand picks up and exports rebound, that will provide support for the currency. But if the global slowdown continues, it will add another layer of pressure. Finally, we need to keep an eye on the domestic banking and real estate sectors any further. Instability in these areas could undermine investor confidence and weigh heavily on the VND. However, I want to add a crucial point of perspective here, because while these current challenges are very real, it is important not to lose sight of the structural resilience that Vietnam has built over the last decade. Unlike past emerging market crises, the country now has stronger foreign exchange reserves and a more diversified export base, which gives policymakers more ammunition to defend the currency and stabilize the financial system. This is not the same vulnerable economy of 15 years ago, and it is far better positioned to absorb these external shocks. But of course, resilience does not mean immunity. And for sophisticated investors watching this, the current volatility should be viewed not just as a risk to be avoided, but potentially as a strategic inflection point for those with a high tolerance for volatility and a truly long-term investment horizon. Market dislocations like this often create unique opportunities where asset prices temporarily disconnect from their underlying fundamental value, and we might be seeing the beginnings of that dynamic starting to emerge now. But again, this requires deep due diligence and a robust risk management strategy. And for multinational corporations operating on the ground in Vietnam, this is the time to aggressively review hedging strategies and ensure that currency exposure is not going to wipe out operational profits, because hopeful waiting is not a strategy in this environment. So in conclusion, the recent movements in the Vietnamese dong are a complex phenomenon, driven by a combination of global headwinds, domestic policy challenges, and shifting investor perceptions. It is a story that is still unfolding, and it is one that requires careful and nuanced analysis for investors. It is a time for caution and due diligence. The long-term growth story of Vietnam remains compelling, but the path forward is likely to be bumpier than it has been in the past. For businesses operating in Vietnam, managing currency risk is now more important than ever. And for policymakers, the challenge is to navigate this turbulent period without derailing